So today I was planning to talk about what are two big things. Yeah, so one is yesterday I read through the report on big tech, big bets. That's really a long report. I'm not going to go through that in full detail. Maybe we'll cover some of the things that I noted from there. But I think the more important one is getting little back to basics around option stuff. Right? And there's a lot of chatter coming back in the markets, especially over the last, I would say, 2 months. People getting excited about the market, right? And this is where it is completely opposite of what we should do. When the markets are going higher, investors get a lot more excited to go into the market, which means, hey, buying high. When the markets are not going higher, everyone is shit scared of the market and want to pull out of the market, which is what we should be doing the opposite. But I do see a lot of new investors talking about options and talking about covered calls on my Twitter feed. So I guess a lot more folks are interested in suddenly getting interested again in options. I don't know how it's going to happen after this week, because this week the markets were, they did what they generally do. But I do want to talk about going back to basics on options. So over the last few weeks, we started covering, hey, let's talk little basics on options. A lot of new people have joined, in this group. So might be useful to cover and go back to understanding some of the, bases around how to be a better option trader. So one is going to talk about the setup for option trades, right? When you try to open an option trade, what are things that we should look for / we should watch for, so that we don't become a news headlines around option trades, right? There is never a good news headlines when it comes to the options. At least I've not seen much. Most of the headlines that we see are all around bad things happening to option trades, right? So what is that we should watch out for so as not to become part of that headline is what I do want to talk about. I don't know anything else you guys have in mind. Of course, we'll look at general what happened in macro and all that stuff. Cool. Alrighty, so I see two Rosses here. Maybe Ross, you joined from another device, looks like. Yeah. Okay, let's coming back from the market perspective. Overall, I think markets pulled back a little, right? It's been, we've been noticing it's been crazy unidirectional movement over the past many weeks. So I'm not at all surprised that the markets pulled back. I think it's kind of expected. Some part of a time, people will take profits, or you can't go in one direction continuously. So good to see some little bit of a healthy contraction. Maybe it is triggered by Jerome Powell's comments during the testimony, but kind of I didn't find anything very specific which was a news to us. I mean, chairman had already told during the earlier press conference last week during FOMC that is going to be 2 rate hikes. Don't celebrate too soon. But markets have been like, hey, everything is about AI. We don't care whatever Jerome Powell is saying. So I think he reiterated the same things. So it's too early to celebrate. I don't know. I'm still confused. Why did they pause right now? Whereas none of the central banks have paused. But so it's a little conflicting message. You pause it now and then say, hey, we're going to raise it twice. But anyway, I think the market got the message. Now they're thinking back, is it really worth, staying in the market at this current valuation? So we saw a little bit of a pullback in the market. Nothing to worry about. I guess if this was, for me, this was little expected. So hedges are still on. Those will work out. Nothing serious, no serious damages around the portfolio. So, all right, what else? I quickly want to talk about a little bit on a macro. We are approaching the mid-year point. Can't believe it's already last week of June. So we are almost halfway through. And when we are halfway through, what's our SPY doing so far? Let's pick up how the markets have done for year to date. So halfway through, market is up 14%, right? Which is great. QQQ is up 37%. We don't see that more often, markets delivering such a stellar results. Fred says, I saw SPY consolidate last Thursday, Friday, and from chart on other YouTube, we can see down market happening. That's what happened. Played some options on SQQ, TQQ for profit. That's great. Good to hear. Some said SPY 430 might be a breaking point. So let me just bring that up. Not as a percentage. Right. So I also heard around 430. But we never know. We also have heard around 480 target for the year, and also what, 320. But yeah, if it is 430 is a breaking point, I think we are pretty close to that. From let's see, where does it say from a technical perspective? I think 200-day moving average is still pretty down. 200-day moving average is around, 50-day moving average is around what, 420. It's not even 430. So I don't know, from 430 it might be breaking some other technical. Let's see which one's over there. Not really. It's closer to the midpoint of a Bollinger Band. I don't know how much that make a difference, but yeah, we will see if 430 does it cause market to go down after 430? Is that the level of support that we are looking at? And if it breaks that down, it's going to go further down. We'll see. But over the past few years, the markets have become very unpredictable. We never know when the animal spirits will come back in and then say, hey, NVIDIA is down now 10%. Probably it's a good time to get back in NVIDIA, right? Or some of these 7-8 stocks that have been driving the markets, folks go crazy sometimes on those ones. But we'll watch. 430 is a level to watch. I'll keep my eye on that one. I think it was on Friday, little bit. I jumped on, I had, I think morning 8 o'clock at a meeting, which didn't happen. So I was looking at a Twitter feed and saw spaces. I can't recall the name of the space, but it was like daily Tesla SPY QQQ trading space. Right. So I jumped on the space for 5 minutes, and maybe I think morning markets were not doing good. So kind of like 5 minutes that I spent on the space were all about people blaming others on how they lost money. Probably they're taken some long positions. I don't know whether options or stock positions. And then some senior heads and coming and talking about, hey, anything that we discuss in the space is not a financial advice. So don't go and start trading on these ones. We share these ideas with each other. And so don't come and complain that if the trade doesn't work out. That's the crazy stuff. Yeah, I spent 5 minutes and then my sounds keep breaking up. All right, so let's save some bandwidth. Let's turn off the video. Hopefully that will help. Let me see if the internet connection. Well, I'm connected to the best one. All right. Tell me if this is any better. Okay. Yeah, so that was little fun. I don't know if that's a daily space or whatnot, but that was a little fun to hear. For probably I joined at the wrong time when people were just all complaining about the markets. But anyway, I think still so far markets have been doing pretty good this week. It just got back to be a real market. We saw some, I would say that's a healthy pullback in the markets, right? It can't go continuously in one direction anyway. So yeah, S&P is up 14, almost 14%, mostly driven by, shouldn't be a surprise, mostly driven by just the tech stocks, 7, 8, 10 tech stocks, AI. A lot of AI stocks also got hammered, right? What Palantir got hammered. Look at from all the way from $17 to $13, right? That's a almost 25% loss in a week. Now I suddenly say, because I do track Palantir, as you guys know, I have a holdings in it. I've been tracking this and building my position since last December, January timeframe. So YouTube's logic will show me many Palantir videos, and some of those YouTubers now have suddenly pivoted from Palantir. Now they pivoted to being a SoFi investors over the last 1 week. Interesting to see how the stock market, how the stock price can change investors' view on in just 1 week. So all those Palantirs to the moon are now talking about a different stocks in just in 1 week. And this is just what 25% crash after being up almost 200%. Yeah. But it's crazy. Anyway, there's I don't know what happened to the another one. There is another which is very favorite among YouTubers, SoundHound. You're right. Something, I don't know what's Comcast doing. Are they doing some repair in my area? The network does seems to be slow. I will see. Let me see if I can pull out something else. What happened to AI? Another one favorite among those Robin Hooders. So AI also was hammered. SoundHound, a little bit, not much, but yeah, a lot of those high flyers are now coming back to earth, which is nice thing to see. Also saw some broadening of participation from other stocks. So which I think this pullback to me is a healthy pullback, looks like to be a healthy pullback, which would set up a better base for market being bullish in the long term. Saw some pullback among the big tech stocks that have been driving the market so far in AI stocks, and saw more participation from the other sectors and the other stocks that haven't participated till now. So some cyclical sectors like industrial, materials. It didn't occur to me till now that industrials, which is sell oh come on, XLI actually hit a all-time high, which was I was very surprised around that. Or this doesn't have ETF. What's up with the network? All right, something fishy with the network. All right, Comcast, you gotta do a better job. Yeah, I didn't realize it, but I read somewhere that XLI was actually all-time high last week, 106. Yeah, almost close to all-time high. which was crazy. We never looked at industrial or these old economy sectors or the companies, but while the majority of the stock market have been driven by the tech side, quietly a lot of these industrial companies have done really well. I mean, this is where it helps. If you don't track the sector or you don't track the individual companies, don't track the sector, I just buy a ETF. So it was a surprise for me to know that XLI is actually hit all-time high, right? This is where the diversification helps. So seeing some broadening in the market with industrials and minerals coming back, that's a healthy one. And lastly, we also know Federal Reserve and central banks globally have told they're not done. They're not done with their rate hiking. So expect more. I think that's the reason why this week market kind of realized, hey, he wasn't really joking. Probably we should see more hikes coming in. Right? So 3 key trends. Economy and inflation are likely to cool, which are, I would say, counterbalancing forces. So economy, so far the economy has been very resilient because of a strong labor market, but now we are starting to see some kinks in the labor market. Labor market has started to ease now, and if you look at this chart, that shows the weekly jobless claims over past 1 month has suddenly gone higher, and the people who have been quitting their jobs is going lower. So now a lot more people are returning back to job market, and when people are more afraid of losing their jobs, the jobless claims are going higher. They're not going to spend as if there is no tomorrow, right? That's what has been keeping the economy, because US economy mostly driven by consumers. So far, that's the one which has been keeping our US economy hot. But if the recent numbers have to be looked at, the trend on the job market, if you're starting to see, I think we are seeing some cooling off in the job market, which means it should also impact economy. If there are concerns around whether you're going to have your job in future, you're not going to spend in the economy. So that should cool down the economy, and all the things that we've been talking about, the recession coming in and all that stuff may happen. Now, is it going to be deep? Is it going to be shallow? That only time will tell. Other thing to notice is all the leading economy indicators like ISM manufacturing, services index, all that are now moving lower. So from a indicators perspective, clearly it looks like, hey, we should see some cooling down in economy, right? Number 2 is inflation will also continue to trend lower, right? And probably maybe trend towards 3% by the year end, right? So the prices paid by the manufacturers is going down, and for the services has been moving lower. So when the price is paid by the manufacturers going lower, then the consumer prices generally will follow it. So we should see cooling down of the inflation also. So that's what anyway Fed wants to achieve, is cooling down of inflation. Now that comes with little recession in the economy. That would be a healthy recession for the country. Fed is likely to pause its interest rate hiking cycle in the second half, probably after 2 more hikes, maybe 1 hike in July. We don't know. So market is anticipating 1 more hike in July and none after that. Fed is saying probably they will do 2 more hikes in the remaining part of a year, and the overall rates may go up to 5.6%. So after that, no more hikes. Haven't heard about if there's any way they're going to pivot or not, but currently we are looking at maybe 5.6% is the terminal rate for 2023. So Third is there are some opportunities that have started to form, not just in the hot tech AI companies, but some of those market leadership is starting to now come from industrial materials, etc. Uh, we have started to see that the S&P leadership is a little bit broadening now. XLI hit all-time high silently. Nobody talks about industrials anymore, but it started to regain, show its impact on the overall SPY. Sector-wise, sorry, the table has to be changed because Fidelity had removed the old page, and looks like someone on Fidelity told, that page is no longer looks good, and I couldn't find that 5-day data anymore. So now on Fidelity website, all we have is maybe 1 year to 1 month of data. But anyway, so overall, infotech, communication services, consumer discretionary, all up almost more than 30%. So at least I'm not building any additional positions on infotech, on the tech sectors. Still maintaining my short deltas on QQQs, and have covered calls or some collar positions around the individual stocks, up 38%. That's not to predict that it'll gonna come down, but I think it's a time right now. It's a time to maybe add some protection without any cost. Right? That's where the collars come into picture, where you can buy some puts but sponsor it by selling calls. So if it goes up another 10%, 15%, won't mind, taking gains at 45% to 50%, right? But I don't want to pay for insurance. So callers work out great. On the other side, hey, the other strategy is to sell the covered calls or calls on the ETFs to reduce the cost basis. That's my game plan. And if you really look at energy, utility, financials, these generally form the IWM or Russell. They haven't been performing well. Energy has been the worst. Down 12% for the year. And this was the best performing sector in 2022. And now so far that's been the worst one. That's a market going through its own regular cycles, I guess. So fear and greed index, after a little bit of fall now, but still in the greed stage. And now after watching this fear and greed index for more than 2 years, now to me, it looks like it does pretty much give a signal on when the market is at a froth and correction may be coming. Because whenever it moves above 75 and all that stuff, we'll generally see a correction coming in, right? So be watchful. As Warren Buffett say, be fearful when others are greedy, and be greedy when others are fearful. So right now the market is still pointing to, it's still in greed, right? So I'm cautious about it. I think for me, I again added a little more on the treasury holding, the one which is coming up on 29th. Probably I'll park some cash over there while I wait for the pullback to do any additional stuff. So this was an interesting chart that I saw. It doesn't happen often. It hasn't happened over the last 10 years, but it has happened now. Okay, audio still choppy? Gosh. Yeah. Dave says fine for him. I don't know I can do anything else about the audio. Maybe the internet is today a little slow for me. Okay, so looks like JJ also says it's choppy. All right, so let me try one more thing. Let me try to dial in through phone and then see if that works out. Gosh, I have to find go to the meetup and get the link. Give me a moment. All right. One second.
Recording in progress.
Okay. All right. How is it now? I'll. Okay. Is it any better? Okay. Oh, it's better. So, okay. So I've dialed in through phone, and probably that sounds better. Cool. Okay. Make sure turn off option or Comcast device as a hotspot device for all people. Yeah. The last option is I go back and restart my router and everything else and restart the modem. That's what I generally do, but it will take me another 5 minutes for doing that. But looks like with the phone, it's working fine. So let's stay on the phone. Yeah. Otherwise, that would be a last option. Sometimes I have to just, and it's a few weeks ago, it suddenly started to happen. Then the morning connection would be bad. So I put it on my calendar. You get up 6 a.m., just recycle everything. Go turn off the modem, turn off the router, and restart it. Because my wife used to complain, why the internet is slow? I'm like, I don't know. So anyway, now the phone is good. So let's get back. All right. Yeah. So this was an interesting chart. Hasn't happened in the last 10 years, but it has happened now. Looking at equity risk premium, S&P, which is a medium risk, is yielding 5.3% based on earnings yield looking at 12 months forward. Shouldn't be any surprise that the companies have been pulling back their earning results, right? Even though the market has been going high for the past 6 months, companies have been projections for the earnings have been going down, right? The insanity in the market was because of a few stocks. Overall, the earnings projections have been going down. So looking at now next 12 months forward earnings and the current PE ratio of S&P, the return that you could get is like 5.3%, approximately, let's say 5%. I'm not sure it's exactly 5.3%. What's the S&P PE right now? SPY PE current. Let's say today's PE ratio. Oh, we're looking for a forward one. So today is like 25, which is way higher. That means it's like 4% is your return. 12 months forward, the yield comes out to be 5%. Corporate bonds is 5%. T-bills, which is no risk, is also 5%. So what do you want to own?
Isn't it 3% though?
Which one?
The second one.
Corporate bonds?
No, the one after that.
The treasury bills? Treasury bills?
I'm sorry, I'm just confused. Like, I'm like really lost.
Okay. No, so the treasury bills are still yielding. 3 months treasury bill is yielding around 5%. I mean, as of mid of June,
But like, don't you multiply that by like the second quarter?
No, I didn't get multiplied by second quarter.
Or the first one?
No, so right now, if you go into T-bills and look at, let's say, 17-week T-bills, they're probably yielding closer to 5%. I mean, I had the one which was the recent one that got in mid of June, that came up around 5%, which is like 3 months T-bills. 17-week, yeah, had it around 5%. 627 was the most recent one, and it's around more than 5%. And S&P, looking at their PE, which now looks to be around 20, maybe looking forward, that's also around 5% yield. So the question, which one you want to own? I am still, apart from my 401k, I am still stacking T-bills. Just like Jay says, keep stacking T-bills. I'm also stacking T-bills. And of course, some of the stocks that I had to sell because of my covered calls or call spreads were in the money. I'll probably go and buy back those. I have some short puts for those stocks. Other than that, not building too many positions in the new stocks right now. Just it's the risk is risk and the reward right now is not that attractive, right? I think we talked about this equity risk premium maybe 2 weeks ago. Is sure, if S&P is down a little bit and I get paid enough of a premium to take that risk, I'll take it, right? We don't have to get into FOMO and start to chase the market when the market is up 13%. The QQQ is up like 40%.
I don't want to interrupt, but like, let's be real. This shit is so fucking confusing.
Sorry, you broke up. I say Miles says I lost 500K.
Yeah, no, dude, it's just like this shit is so fucking confusing. Like, I'm trying to learn, but I'm just fucking lost, dude.
All right. I guess then you maybe just wait for some time. I don't know what exactly you want to talk about.
What is it? Excuse me, Ross. Are you calling me a doom bomber? Because I'm just like really confused. Like, I lost 500K on T-bills, and I'm like looking to learn, but like,
yeah.
So
I mean, not just you. Probably a lot of other folks have lost a lot of money holding treasuries, but depends on what's the maturity of the treasuries, right? We have seen all banks imploding because holding long-term treasury bonds. And when the inflation goes higher, yeah, all those values have come down. So treasuries only help if you can hold to maturity, right? If you can hold it to maturity, still survive, nothing has been lost. If you lost it because you have to sell it now, that's where the problem comes in. And that's a fact of the life. Many banks are going through it. And as a retail investor, I mean, we've been talking about it. Treasuries are safest if you can just hold it. Right from your buying of treasuries until the maturity period, anything could happen. And sorry if you've lost 500K, it may be because you had held a long-term maturity. Mine, the treasury that we've been talking about, and all right. Treasuries we've been talking about and hold. Been holding is around. All right, you can ignore the messages. Have been only 17 weeks, 26 weeks. Because I don't know how long, because I want to also make sure when the market presents opportunity, we have a regular cash coming in. So I've been only doing 17 weeks, 26 weeks of treasuries, and those have been working beautifully so far. And build a TB ladder so that you don't go all in at one time. That's been my game plan. You can do whatever works for you. So yeah, I mean, you make a decision. If I mean, every investor has to make decision for themselves. For right now, for me, equity risk premium is not that attractive. So for now, treasuries are a good way to hold some cash. So last week, buys and sells is nothing bought, nothing sold. But now I started building my August expiration trades. We are from when it comes to the August, we're almost 50 days, 55 days out for August. If you look at August is 55 days out, and the July is now 27 days. So it doesn't help in putting new positions in July. It's very close to expiration. Generally, once it is below 30 days, I don't want to add a new position unless it is really, unless my confidence is really high. So I started building August expiration trade positions, options perspective, right? If I would have sold a couple of covered calls, did a put spread and the covered calls and all variety of trades that I generally do, but it's time to start building August expiration positions. Looking at the crypto side, while the rest of the market has been going down, we suddenly saw, not suddenly, I mean, if you have been watching the market, that shouldn't be any surprise, is that the crypto market has been going higher. Saw Bitcoin hit more than 30K after a few months, I guess. And the reason is probably a lot of traditional financial institutions. They have kind of provided support to the market, which is generally don't see a support coming for Bitcoin from traditional financial market. But over the past, I would say 1.5 weeks, all the positive news or the hope in this crypto market has been coming from the traditional markets, right? Deutsche Bank, on Tuesday, they applied for digital asset custody, one of the biggest banks in Europe. EDX, new crypto exchange, which is...
Shouldn't we keep it in America though? Just keep the V-Bucks.
Keep what in America?
Well, just keep the money in America. I just don't want it to go outside because it makes it more risky, right?
I don't know. Some of the international markets have done better. So,
listen, I'm gonna be honest. I just invested. I did not know anything about this. I just invested 500K into a random one. So, I don't know.
So I think investing in randomly without doing your own study is a sure shot.
Yeah, well, no fucking shit. I lost all my money.
Yeah. So if you don't know what you're invested in, I'm sorry about that. I mean, you're putting yourself in that trouble.
No, right? It's good. I just want to learn though. And then Ross is out there calling me a Zoom bomber.
No, you can learn. Be here. That's what we talk about. And yeah. But if you're investing in something that you did not know about, and then you lost money.
Okay, yeah, I know it's stupid, okay? My dad told me 1,000 times before he hit me.
Yeah. So, yeah. So here we want to talk about stocks. We can talk about stocks. We can talk about options. And yeah. So anyway, so for me, let me proceed. I also want to talk about opening option trades. So we are almost 45 minutes. So if you have anyone have a questions, can put in the chat. I do want to move forward. All right. So why we saw some healthy signs of the crypto? A lot of the traditional ones came in. Citadel, Fidelity came back in. They launched a new market called EDX markets. Right. BlackRock filed a spot BTC exchange. This was the biggest news of last week. BlackRock, as you guys know, is the biggest asset manager in the world. Invesco applied for their Bitcoin ETF because they don't want to be left behind if BlackRock is going in, because everyone knows whoever is the first one to get approval for the Bitcoin ETF are probably gonna get most of the money coming in, right? So that's why Invesco has reapplied, and I think there are a few other companies that have reapplied. SEC approved the first leverage Bitcoin ETF. So you see 2x Bitcoin strategy ETF BITX have been approved by SEC, which might give a sign that, hey, SEC may want to SEC is probably just give me a moment. Yeah, SEC may have cooled down their stance towards Bitcoin and crypto economy, because they now approved another, they approved 2x Bitcoin strategy ETF. Finally, GBTC has continued to soar, reducing the difference between their discount and the NAV, right? Jason, I can't tell you about an individual stock, so that you have to decide on yourself. Okay, all right, is out. Okay, one second. We'll gotta do some little bit of a cleanup, so let's do that. Yeah, everyone is now free today. Looks like a lot of people have nothing but to Zoom on. All right. Yeah, that's what I'm spending some long and doing that cleanup now. Cool. So that's what we saw on the crypto side. Other thing that I found interesting was a little bit Howard Marks' thoughts on risk, and which was, hey, the trick is not to avoid the risk, but to manage the risk, which was a very, I would say, insightful thought. Is most of us try to avoid the risk, saying stock investing is risky, options are risky, but the real, I would say, the real money is made when you can manage your risk well, not just to avoid the risk. So there is a very good presentation or lecture from Howard Marks. I just put around the risk one, where this says, if taking risk is not good, then life insurance companies will never insure people, right? Because they still go and insure people when they know for sure that the folks will definitely die. But why they do it? Because the risk is measurable. The risk is predictable, risk is manageable, risk is spread, not concentrated. Finally, the premium justifies the risk that is taken. Right. All right. I need to kick now some folks out. Guys, if you play nice, all are welcomed here. But if you're not, I'll have to kick some of the folks out. All right. Yeah, today, I would say this is the badge sometimes you have to earn when you got a Zoom bombers. Means, hey, that's a badge of honor. I'll take it that way. I guess all other names, I recognize it. Cool. All right. Optionstrat.com. No, I don't use OptionStrat, Freddie. There we go. Okay, lock the meeting. I hope those who are stragglers, I know a couple of people joined just recently. Those have been regulars. Now the meeting is locked. And so that we can continue with our work. All right. So I was thinking about this when I heard Howard Marks talking about the risk. I'm like, this is just exactly what we do in options, right? Or at least what I follow in options when we try to sell an option trade is, yeah, it is risky, but the risk is measurable. We know exactly how much we're gonna lose. I mean, if you do spreads, when you put an option trade, the risk is predictable, right? You pick up your delta based on how much risk you want to take, right? And that delta is based on how the markets have behaved or the particular tickers have behaved. So the risk is predictable, risk is measurable, risk is manageable. Unless you have gone, let's say, naked calls on the stocks that you don't own, we can pretty much manage the risk. Most important, the risk is spread over millions. In our case, you do want to spread all your risk over hundreds of trades, right? Not just on one trade. And finally, when we do an option trade, we look at, does the premium justifies the risk that I'm taking, right? That's where we wait for maybe a higher IV, implied volatility to be available so that we can get paid for the amount of the risk that we are taking. Okay. So that I thought maybe this is exactly the thought process that we as an option investor / trader should go through when we are setting up our own trades. Right? Avoiding risk is not the way to go, because if you are avoiding risk, then we all can be happy and stay, keep the money in the bank. Or I guess right now even T-bills are offering nice ones. But long term, that really doesn't work. The question is, how do we manage the risk? So that taught me maybe we should go back and review when we're trying to create an option trade, what are the things that we need to watch out for so that the risk that we take is manageable. And the risk that we take when we are selling options is not concentrated, right? So that's why I thought maybe go back to basics, go through the idea of opening an option trade, go through the whole steps of opening an option trade. Sounds good? Will be helpful. I know we covered this maybe 2 years ago. I don't think I've spoken, we've gone through this after, now doing it maybe after 2 years, on what we should watch out for when we are opening an option trade. Let me look at option strat. I don't know what kind of statistics Okay, predictor strategy, optimize an idea, view unusual trades. So unusual trades hasn't really worked out for me. I mean, you have to be really be very nimble when you're working through unusual trades. And because I'm not full time, that's not been a winning strategy for me. Right? Okay. Use strategy builder to create and visualize expected profit and loss. I do that on Thinkorswim anyway. Optimize an idea. I don't know what's in this one. Yeah, so these charts I get from Thinkorswim. So I don't know. I also heard about option strat from someone else, but that gentleman didn't have Thinkorswim, and he was talking about these things. So yeah, Freddie, if that's useful, continue to use it. I haven't used option strat. Cool. All right, let's dive into maybe things that we should, or the steps to create an option trade. I know I did that 2 years ago. Just give me a moment to pull it back. All right, do you think that will be useful? Going little back to basics. All right, just let me know. Hopefully by accidentally I haven't turned off the chat. No, I think that is right. No. Okay. Okay, so Fred says yes. No. Cool. So let me just get through that presentation once again. So why checklist, right? Why do you want to go through when you're trying to open an option trade? The reason why you should have this checklist, and believe me, years ago when I started, I had a post-it on my desk, which reminds me of this, but slowly it becomes a muscle memory. Then you don't need that. You need checklists so that you are consistent and don't let emotions drive your trade, right? Oh, suddenly I get to see, oh, Palantir is going to go to 20 from 16 to 20. Maybe I should go and sell a lot of puts around that, right? Just to take emotions out of a trade. That's where the checklist will help. Run through your checklist to make sure that the trade makes sense for you or not. Yeah. The first one, those who have been hearing me for almost more than 2.5 years, or maybe close. We are hitting maybe close to 3 years now. But my thesis still hasn't changed. The most important thing is position size, right? And the checklist is in the order of importance. So the first thing is position size, right? Don't let any risk on any of an individual taker to be more than 5% to 10% of your overall portfolio. I don't care whether you know the CEO of that company or whether you know someone in the boardroom of the company. Don't let any ticker to be more than, let's say, 10% of portfolio. Now, what I'm talking about here is all around short options, right? Selling options, because that's work on the long term. Buying really doesn't work out. So I'm focused on, if you're selling options, how do you control your risk? How do you be profitable consistently? Don't let any of a taker or the risk to be more than 10% of your portfolio. Right? Don't ever violate this rule of position size, because if you're right on this and go wrong on all the other checklist items, you will still survive. You'll still fight another day. But if you are wrong on this and you pick up the best ticker and you picked up the best time and you picked up the best strike price, but if you're wrong on this, nothing else will matter. So I see a message, you lose track of time when you're learning and enjoying the results in green. So it is very important on what's the position size is. Number one rule. That's the most important rule when you're trying to open any option trade, specifically when you're trying to sell options. All the headlines that we see, which we don't want to be a part of that headline, is because they violated this rule. So here's a empirical or mathematical result of why I focus so much on the positioning. If you've done a 50% probability of profit trade, right, which is maybe you didn't at the money, you sold an option at the money, which is 50-50 probability of profit. That theoretically means you have 1 in 2 chances of making money or losing money, right? If you've done 2, then your consecutive losses means, let's say if you have done only, this talks about your number of consecutive losses, means how many, if you did 1 trade and then you did another trade, then you did another trade, what are the chances of you losing all those trades, right, consecutively? If you do only 1 trade, you have a 50-50 chance, because it's a 50% probability of profit. You did only 1 trade, you might lose one of them, or you might lose, you did 1, you just lose 1. You did 2 trades, the probability of losing on both the trades is 25, right? You did 5 trades, the probability now reduced down to 3%, and that's you're doing at a 50% probability of profit. If you're doing 60% probability of profit, which you can figure out looking at the delta of your option position, delta of your trade, right? As you increase the number of trades, your probability that you will lose consecutively goes exponentially down, right? You may lose 1 trade. That's perfectly okay. But you do another 60% probability of profit trade, and you may lose that also. But if you've gone too big in your initial position size, that your overall capital allows you to do only 4 trades, then there's a high chance that you could end up blowing your account. Right? That's why the position size is so important, to keep it at 5%, to keep it at no more than 10%, that it allows you to do at least 10 trades, minimum 10, right? And the probability of losing 10 trades with each 70% probability of profit means selling an option at around 30 delta is very less. It's only, it's less than 10%. But if you've gone big, you did only 3 trades, you picked up those 3 trades, at 70% probability of profit, there's still a 30% chance. If you've done only 1 trade, there's still a 30% chance that you could lose 100% of your or money. So that's the position size is super, super important. As you continue to work on more and more trades, you realize that if you keep your position size in control, the chances of blowing up your account is very, very less, even though you are doing trades with unlimited risk. And that is why I'm okay to do with, let's say, naked trades on ETFs. Because I'm keeping my individual position size very small. So that's the, I would say, the cardinal rule. The most important rule is to keep your position size small. One example of position size goof up, right? $150 million lost in 3 days by option selling. And these are so-called the gurus of option selling. This guy has written a book on option selling, but probably he didn't follow his own book. And they took a very big naked position in natural gas And when natural gas flared up, basically that was a natural gas futures, they got a margin call and had to wind up the account. It's not enough that when it comes to investing, especially around options, it's not enough that you theoretically know it. You need to have the guts, or you need to have your stomach to follow and not give in to the FOMO and all that stuff. Don't go big, right? Irrespective of whatever you might be hearing in the markets. Okay? We see professional growing up their account. This guy had written a book on option selling. And strategy was correct because prior to 2018, natural gas had been in a downtrend. So strategy was all fine. And I think it was the weather change in Europe that killed this hedge fund. Suddenly there was a huge weather change in Europe. And because of that, the natural gas just blew up, and this whole the hedge fund had to, I would say, wind up. If they had a position size correctly, eventually after a few months, the strategy and where the natural gas would head to was all correct. Natural gas actually came down to where they were predicting to, but meantime, they just couldn't sustain the margin calls because the position size was too big. So that was one example. The other one, it came in 2021, right? Bill Wong from Tiger Cubs, the famed group of Tiger investment, the prodigies coming from Tiger investment VCs, so-called Tiger Cubs. The blew up Archegos blew up because they had two big positions on very few concentrated bets on the stocks. Right? When the stocks fell down slightly, same stuff, margin call came in. And if you talk to any so-called stock investor or the financial advisors, the biggest reason why they want people to stay away from selling options is everyone is scared of margin calls. Right? You'll get margin call if you get too big on your individual stocks or on overall buying power. So keep your position size in check. Will all be good. And Archegos had actually 20x leverage. So one is the position size. I see a question. So Naresh says, same thing happened to Lakeside Capital on top stock short squeeze. Do you know what delta was using on short call? I don't have that information. Probably I would have forgotten. It's been, 5 years, more than 5 years. But this hedge fund manager actually came on YouTube and apologized to his investors on, how he lost all the money. He was almost to the end of almost crying at the end of a video. Yes, this is the famous crying video. Yes, James Cordier. And I think then the lawyer suggested to remove that video, but by that time, a lot of other folks had posted that video and many other platforms. So strategy was right, everything was good, except the position size was wrong. So more important is position size. Number two is a portfolio fit. I think this, as a stock investor, we already know should diversify our assets, right? Have you already got enough of tech? Now the tech is been going high over the past 6 months. Right? And if you already have tech, do you really want to do another short put on tech? Just because QQK is going high? If your overall portfolio is already heavy on tech, maybe you should not do another short put on tech. Right? Maybe reduce your deltas on the tech side. Are you overexposed to a particular sector? Why do you need to do another trade in the same sector? Now, if I am looking for some bullish trade because, hey, I want some bullish, I want to add some bullish deltas in my portfolio, I'm not going to do in the tech side because I already have enough of tech. Maybe I should do a little bit on other sector. There are 12 S&P sectors, or I guess 11. Maybe pick some other sector where you don't have exposure already. More important, liquidity. And again, going back to asset diversification, 2022, if all that you held in your portfolio was tech, you can't blame the market saying the market went down. Markets will always go up and come down. That time, it's a time for introspection on, hey, why did the heck I lost so much, whereas the overall S&P didn't lose that much. Overall S&P was down 18%. But why the heck I lost 40% or 50% or 60%, right, depending on what kind of stocks you have. Because all those stocks were high growth tech companies, then it's not the market to be blamed, right? Or it's not the YouTubers to be blamed. It's our own choice of concentrating our portfolio into the high growth tech companies. And then that's to be blamed. So diversification important. So we already look at two checklists. I haven't yet come to what's the strike price you're looking for? What's the strategy you're looking for? But unfortunately, when anyone wants to do an option trade, first thing they ask is, give me the ticker and tell me what the strike price is. No, that decision will come way late. Of course, we need to know what the ticker is, but there are many other layers of a decision which you should take in your mind before you find out, okay, this is the ticker that I want to invest or put an option trade in. And we will come to that. But unfortunately, most of the newbies on the option just start from ticker and the strike price. And that is when someone asks me, is this a good trade? I'm like, it's good trade for me. I don't know about you because just by looking at a ticker, I can't tell you it's a good trade for you. Because I don't know these other things, right? I don't know what's your other current asset allocation is, what's your portfolio is. Maybe you already have many trades on that ticker. I don't know about that. So it is impossible to tell if it is a good trade just by looking at a trade. It is a good trade for someone. I don't know about if it's a good trade for you, right? Thirdly, the stock should be liquid, especially if you're dealing on options. This matters a little bit on the stock side, but if you're dealing on options, make sure the underlying stock is liquid. Number two is that the front month option volume and the open interest is decent enough, right? Now, the reason this is because if it is a liquid, if you're trading in a liquid stocks, right? Not trading on, there's stocks, there are only 20,000 stocks that are being traded, right? Then the whole bid-ask spread should be so wide that getting in and out of a stock, you just lose money. It's just like a tab that you pay to enter into a bar, right? Your cover charge, sorry, that's the cover charge that you pay. That tells me I have not been in years and forgot what the term used to be. The cover charge that you pay is very high if the liquidity is, if the stock is not very liquid. So look at the bid-ask spread. It should be tight. Liquidity also provides us flexibility in case the trade is going wrong. Because then if I have to manage my trade, then if the bid-ask spread is tight, then I don't lose or I don't pay up to manage the trade, right? So very important that especially when you're trying to do options, pick up very liquid tickers. Well, this tells us the presentation is 2 years old because I still have FB, right? Apple, Bank of America, you can look into any stock screener and pick up the stocks that trade at least 500K over in a day, right? That's a kind of a benchmark. It's not a science, but something that you should look for. Now, have I traded in options in the stocks that don't have 500K? Yes. But the reason is I hold the stock in my portfolio, and then I'll do covered calls or spreads to reduce the cost basis, because I already hold the stock in portfolio. But if I'm doing pure play option trade, right, only thing that I want to get from that option trade is just harvesting the premium, then I'll probably stay away from illiquid stocks, right? So one example is, let's say, Mercado Libre. It has got a wide bid-ask spread. If I'm not holding Mercado Libre in my stock, I won't use Mercado Libre for a dedicated option-only trade, right? How much Mercado Libre trades? Let me look at that. How much Melee trades in a day? Okay, volume is still okay, but the bid-ask spread on that Melee is wide. I mean, I would rather want of a better one, but it has got a wide bid-ask spread, right? But I still trade it because, hey, I hold the stock in my portfolio, and I try to reduce the cost basis on that stock. So I don't have any other option to reduce the cost basis. Either the stock gives dividend, which I can't control, or I reduce the cost basis by getting option premium. So why Melee has such a big ask spread? Number one, the stock is of a very high value. It's like $1,200, $1,400, $1,500 stock. So in $1,500 stock at ADM, $5 is kind of expected, right? Even if you look at but this is almost like $8 wide, right? $7-8 wide. Number two, is not that thickly traded. If you look at option volumes, etc., open interest, it's not that too much. That's the reason. If you pick up a strike where you have a higher open interest, a lot more buying and selling happening, you see that is little tighter. But this is not a stock that is covered by many analysts, or this is not a stock which everyone talks about it, right? So just there's not that much of awareness, and that's why it is not traded so heavily. It's only 700K volume or 800K volume, which is nothing compared to, let's say, Meta, 51 million volume. And if you look at a Meta bid-ask spread, that's 15 cents. Still not as tight as I would have expected for someone trading 51 million, but I guess decent enough. Apple, Teslas are the ones which are generally very, very tight. Okay, so I think they right now this, so this is 2 cents, 3 cents. Sometimes you'll get, right now spreads get better, because right now the market is closed. Generally, Apple, you will see trading at a 1 cent bid-ask spread. It's so liquid. And when people say, hey, stock trading, it's a Wall Street trade against you, and they can make a lot of money against you. Your stock, retail investors can't fight against Wall Street. I'm like, it's a 1 cent difference between buy and sell. I don't care if Wall Street makes a cent against me. So very important to look at the liquidity. And again, if I do any trade purely for premium harvesting, I'll not violate this liquidity. But if I am holding stocks in my portfolio, yes, I violated the liquidity rule, just because I don't have any other option to reduce my cost basis, right? Next one is implied volatility. Right? This is where, is it paying me enough to take the risk? Last 2 weeks, I've been waiting for market, the VIX to go higher, or not the implied volatility to go higher in the stocks, because it's just not getting paid for selling option. So this week I was a little happier because of the, little bit of a panic. I saw volatility going high in many of the stocks that I hold, and then I did covered calls against it. I've been waiting for little IV to catch up so that I can get a little more premium. Okay. So higher the IV of a stock, more is the premium that you receive. 2022, we were getting amazing premium to sell options on the stocks. It was one of the best years in last 5, 6, 7 years to sell covered calls and get some decent premium. More is so if the IV is higher, more is the opportunity for us to make money because we get higher premium to begin with. Right? Now, these are specific to each stock, so I can't tell you is IV of 20 is good or IV of 50 is good. IV of 20, say for a utility stock, probably decent. IV of 20 for Tesla is not at all decent because these are specific to each stock. Or okay, so I do have an example. Looks like IV of 50 for XLE is better than IV of 80 for Fubo. Right? Fubo is a sports streaming company. When it came to public in 2021, kind of a meme stock, IV of 80 wasn't good enough. So how do we know that the current level of IV is good enough for this particular stock? Right? That's where the concept of IV rank comes in, which you compare, let's say, I don't know, what's the IV of XLE? Since I had an old example of XLE. So IV of XLE is currently 24. Is 24 good enough? Looking at last 1 year of a data, it's not, because it's sitting here and mostly it's been higher than where it is right now. So if I were to initiate a position in XLE or a trade in XLE right now, it will be purely driven by direction. And then the stock has to cooperate me in my directional bias, because volatility side, not enough of a premium to make money through the volatility. Right? And that's the beauty when you're talking about selling an option, you can make money in 2 ways. Number one is a direction, that your stock works or goes in the direction that you put a trade. Number 2 is from a volatility premium. Stock hasn't moved, but the time premium or the time premium you'll still earn. And the time premium is more if the volatility is higher. Right? So now if I were to put any trade, it has to be purely based on, I think I'm a bullish on this stock because now it's hitting closer to the lower end of a Bollinger Band or whatever, other indicators that you follow. Right? But if the stock doesn't cooperate, I don't have a too much buffer coming from a volatility premium for me. So I see a question, Friday. How did you add that option to the chart? This on Thinkorswim, this is called a probability of cone. So if you go to studies and say edit studies, you will see probability of expiring cone. You search here and just then add to it. Basically, this tells us that there's a 70% chance that XLE will stay between 82.7 and 72.18 at this expiration. There's basically one standard deviation. This is the one standard deviation probability. There's a stats that goes into options. So if you are picking up your strike, okay, now I'm switching gears because you asked for a probability of cone. This helps us to know if you're picking, or let's say doing a pure option trade on XLE, maybe there's a 30% chance that it could go above $85 or below $70. 70% chance of staying in between. And again, it's the probability. Doesn't matter. Doesn't mean that it will stay in here, but there's a chance, 70% chance. And when I want to do a trade, I want to make sure that I have more than 50-50 chance, right? More than a coin flip chance. So that's where the probability of cone could help you. All right, yeah. So coming back to this, IV bad, but I did see IV spiking a little bit in Disney. So I did a Disney option trade this week because I saw, okay, IV has now come back up in Disney, right? Still not the best, but I'll take what market gives. I've been waiting for IV to spike a little bit to do some trade. Okay. There's a caveat with probability. It is only overall IV, not individual expression IV. So better is to look at IV rank, right, which compares how today's IV is as compared to your last 1 year, right? So if I'm looking at going back to XLE, right, IV rank is 2%, means 98% of the time the IV has been higher in last 1 year where it today is. It's a relative measure of the IV of the stock as compared to last 1 year. And things could happen. Suddenly, some stocks could become more volatile. Now look at, I don't know what Tesla's IV is decent, right? And this is where you see the call, the call skew on the call side where the stock is going higher and your IV is increasing on the stock. So Tesla has a decent IV. Even the IV is 67. IV rank is 34%, right? Yeah, 30 means 66% of the time it's been higher. So it's not as bad as 2%. Right? So IV rank is important. Higher than 50 is ideal, but you don't get, we had some ideal chances in 2022. Today, I would say 30 will work, maybe 25 will work, 20 will work. Because in since it compares from the last 1 year, it is comparing where the IV was in 2022, where the IV was higher. So that's why the IV rank right now is lower. So as you work more around this, you'll start to mentally figure out, maybe this year I think 20 is good enough for me. I don't have to wait for 50 because you're never going to get 50 because the currently IV they are comparing is with the IV which was in, let's say, October 2022, September 2022, during that time frame where it was already very high. Right? So wait for, this is where I would say, wait for the opportunity and don't go big on trades, unless the setup is with you. One of the setup is if IV rank is in your favor, that time maybe instead of doing one contract, I will be ready to do 2 contracts. But if IV rank is around 2, IV rank is around 10, maybe I'll just do 1 contract. I don't want to go big when the IV rank is low. So because then I don't have that buffer coming from option, from the volatility premium. Next is there where we talk about option strategy. Okay, IV is good. I don't have my position size, I'm not too big on this ticker. Now moving from a individual ticker to asset side. Yeah, oh, this is a utilities ticker. I don't have a utilities exposure, so this is good for me. Liquidity, I pick up this utility stock. Let's say, I don't know, Enphase. I generally don't deal in utility, so I don't know which tickers. So okay, I picked up this, does 4 million, has a tighter bid-ask spread. Okay, good enough. Let's look at an IV. IV is decent enough. And now I want to look at what's the option strategy now I want to do. So the strategy comes fifth in criteria, right? Now I can look at, now you can use all your technicals if you're a technical trader. If you are purely looking at, just the deltas and say, or whichever way. If you are the follower of efficient markets and you think everything is already priced in and you want to go delta neutral, go for you. But if you are follow Bollinger Band, then you might be thinking, oh, this is lower. It has gone below its lower Bollinger Band. Probably it's a signal to buy it, right? Then you can think what strategy you want to do if you want to buy it, right? Do you want to sell a put here? Do you want to sell a put spread here? That's a decision you can then make. So strategy comes pretty late. Then you can decide you want to cash, naked put spread, or if you're a bearish, then figure out whether you want to sell a naked call spreads, or you want to go to neutral, right? Then there are different strategies depending on what your outlook toward the stock is. But these things come very late. Don't jump into the strategy immediately, but figure out where does the stock even fit into your portfolio? Are you getting paid? Do you have enough buffer from your risk, volatility risk premium, time premium to do that trade? Is it favorable time to do that trade before you jump into the strategy? Then you can skew any of the trades. Oh, I'm not entirely bullish. Maybe I am slightly neutral to bullish. Then I might do still iron condor or a strangle, but slightly skewed towards bullish, right? The delta of the put will be more than the delta of the call. So still kind of a neutral to bullish, slightly bullish trade, right? And that's the beauty on the option is you can create any kind of a trade based on what your outlook towards the market is or the stock is. In the stock case, it has to be either bullish or bearish. There is no midway between it. So one important thing that you look here is, great, on an individual stock, you looked at that, hey, this is a bullish trade I want to do. Now, as you graduate in your option side, to start moving from an individual stock to also look at, is it helping your overall portfolio direction? Right? Is your overall portfolio already too bullish? Then even though this individual stock, you might be looking to a bullish trade, but it's going to make your full portfolio even more bullish because you added one more bullish trade on top of it. Right? Now, these are the decisions you start taking it when you're moving away from individual stock to overall portfolio management. Right? So I'm having let's say my overall portfolio delta is already 1500 plus. Do I want to add another 50 deltas to it and do a bullish trade? Maybe I should look for a trade wherein I have a short thesis or a bearish on a particular stock. So in this, if my portfolio is already 1500 positive deltas, then maybe I should not look for this trade because this is going to make my portfolio even more bullish. Maybe I should look for a ticker wherein it's gone above the top Bollinger Band, wherein I have a little more, I think the stock actually could come down and add a negative deltas on my portfolio. Right? So that's where when you're defining your option strategy or you're doing a particular ticker, again, this is a little more advanced when you start to think about portfolio. Maybe when you're just starting off, focus on individual ones, but slowly each of the individual stock positions have to help our overall portfolio. Right? So if my portfolio is already too bullish, then finding another, I shouldn't be finding another bullish trade. Maybe I should look for doing a bearish trade. Right? But example in the case would be, I don't want to put a short put. Maybe I want to do a covered call. Then I will go and see, okay, what are the stocks that I hold in my portfolio? And which one of them have gone higher IV? And which of those stock is already, if you are technicals you're following, is above whatever range you want to look at. And I expect the stock to come down. So maybe I will do that trade. Then adding another bullish trade to my portfolio. But this is very subjective depending on how you want to construct your portfolio. Some people are very happy with having, 2000 deltas, whatever. Pick up your number which makes you comfortable. Then I start think about, okay, what's the expiration date to select? Right? Do you want to do weeklies? Do you want to do monthlies? Or do you want to go further out in the expiration cycle? So weeklies, if you're a full-time or on this, go knock yourself off. I only do weeklies if I'm doing earnings play, which is now very far and few. Because when you do weeklies, the gamma risk on the trades is really high. Then if you are managing a trade, you have to also look at which gamma, etc. you're picking. I don't even worry about gammas. Even on my years of trading, I never think about gammas. Only thing I focus on is the deltas. And of course, the IVs, because I don't do weeklies. The gamma impacts start to show up, and the gamma is one of the Greeks of options. The impacts start to show up. The impact of the gamma could make your positions swing way more, even with a smaller change in the underlying stock. So a profitable trade could turn into an unprofitable trade if it is very close to its expiration because of the impact of the gamma. So I don't do gamma. I don't do weeklies because then I have to watch my position really very carefully, which I can't do it because of my job. And I don't want to stay in front of monitor trying to monitor my positions. So weeklies, not my cup of tea. Monthlies is where 95 to 98% of my trades will be, which is, like I said, now I started building August portfolio, right? I sold some covered call for August. I did a trade in Disney with a short put and a covered call combined for August, because now August is 55 days out, regular monthly cycle, picked up a regular monthly August expiration and start putting option trades against it. Third one is if you want to go further out, which becomes your leaps. Right? These are where you go out 1 year, 2 years out. I do it from a capital efficiency perspective. Right? You could use this for your stock substitution. Means instead of buying 100 stocks, maybe you go and do 80 delta, 90 delta, deep in the money call option. Right? That's where I buy call option is if I'm trying to substitute a stock with an option is to go deep in the money and buy a long leap, because then you're not, if you go deep in the money, you're not paying for the fluff, not paying in much for the time premium. Right? But from a capital uses less capital than what you would spend if you are holding the stock. So, and generally these are, what I look at. Some people also want to go 3 months out, 6 months out. I haven't experimented with that. But yeah, after picking a ticket, then you can start looking at how many days to expiration. Today, I don't want to put anything more for July, because July is what now, 27 days, 28. July is 27 days to expiration. Right. Now, if I'm putting a new trade on 27 days to expiration, then it means by the time the gamma starts to kick in, which is generally 2 to 3 weeks before expiration, I want to be out before that, right? So it means if I put a trade now, I probably will be looking to close this trade in next 10 days, right? Very short duration. If I put a directional trade, then it means the stock has to perform in next 10 days. If I stay longer than that, then I have to deal with the gamma impact, right? So I'm like, okay, no more doing anything more in July, except if I'm doing adjustment trades. No more new trades in July. It's time to start building up our August portfolio. And so that's how decision you make for which expiration to pick up. I see a question. This in the money means above current stock price? Yes. So in the money, and when I say deep in the money, I'm referring to, let's say if you have to do an end phase. Let's take an example of end phase, right? If I have to pick up a leap on end phase, which is expiring 70 Jan 25, I would rather go and pick up anything above 100 and 100, anything below $105, means 85 deltas and higher. That's it, so much deep in the money. I would rather go, but you end up paying, let's say, $8,000 for it. But when you're paying $8,000 for it, $80 for this overall, one contract will be $8,000. For the extrinsic or a time value, you're only paying $20. But if I buy this call option, right, I measured 40 out of $51, $47 is I am paying just for the time premium. I don't want to pay for that if I'm trying to substitute for the stock. Stock, there is zero time premium. So I would, if I'm doing a stock substitution strategy, then I would rather go and do 80, 85 deltas, because then at least I'm replicating as if instead of 100, I'm holding at least 85 stocks, right? 85 stock. I have done leap at 90 deltas also, but that's what the deep in the money means. So if I pick this, let's say I want to hold end phase in my portfolio because I'm bullish on end phase. If I pick this particular $90 strike price option, which is expiring on 70 Jan 25, right now it is equivalent to holding 90 shares of end phase, and I'm paying $8,000. If you hold 90 shares of end phase at a current stock price, that is 160, this is much better way. But the difference is you don't get dividends. I don't know if this pays dividend. Does end phase pay dividend? No. You don't get dividends if it's a dividend stock. Also, the deltas are variable. If the stock moves low, the delta will change. In a stock, that doesn't happen. So a little more work involved, but I want to start with as close to substituting the stock, because that's my main motive, is to substitute the stock. Then I'll go deep in the money leap option. Okay. All right, so that's more from a long stock substitution. How does long stock substitution compare when using Margin, if you're on portfolio margin, then I don't think it's that attractive, right? Because if you're on portfolio margin, anyway, the actually Think or Swim or the TD Ameritrade blocks 16 to 20%, right? So you already got 80% of a kind of a margin from here. But if you're a new trader, you don't keep an eye on your buying premium and the margins that you've already consumed, then I would say it's better to do this leap stuff, because then, I mean, if you're not taking, if you're not looking at how much of a margins that sector you're already consuming, that it could come and bite you back. So that's on the day to expiration, how I make a decision, or you could make a decision days to expiration. Next comes the strike price. Okay, should you pick at the money? Should you pick out of money? What delta? How far you want to go? What delta? Now this is purely driven by two factors. One is how bullish or bearish, depending on strategy. How bullish you are or how bearish you are, that will drive how closer you want to go to at the money. Number two is, it also helps if you go back and look in the back month. Back month means the next month. Does the same strike price exist or not? Right. That's more important. So let me explain what I mean by that. Say I want to do regular monthly over here. Now if I'm super bullish about the stock, because, and again, I'm not saying you should do that, because the reason we want to do option is to give ourselves room for error. So we don't get cocky and say, I know about the stock, this is where the stock gonna go. But let's say you are the CEO of the company, you know where you want to go take the stock, and there is no rules around insider trading. You say, I'm very bullish about the stock, right? And then maybe I want to sell at the money call option, or at the money put. And I'm very bullish about this. So you go and sell 40 delta, right? Not exactly at the money, but yeah, it's a $5 white strikes. You sell a 40 delta put. But remember, 40 delta put means your break even in this case is close to $142, right? If the stock doesn't move in your direction and starts to move south after $142, you start to lose money. Or if you did only to buy the shares, great. You'll own the shares at a cost basis of $142. But if you're not that bullish about a stock, you may want to give yourself a little more room for error. Then maybe I'll go and pick up $140 short put. I'm bullish, but I want to give myself a little more room for error, right? Then instead of doing 155, I do 140. That means even if the stock stays here or go higher, I'm going to make $670 on this. If the stock doesn't stay here or doesn't go higher, if it starts to come down, I still have a zero risk on the trade until stock start to fall below $133. So you got a lot more room for error. Now that based on that, you determine what's the strike price that you want to pick. How much confidence you have in your own ability, or I generally go by the statistics, which is looking at the deltas, right? I want to go look at, maybe if I am bullish and I'll be okay to buy the stock, maybe then I'll do anything between 30 to 40 deltas. If I'm just trying to harvest a premium, don't really want to buy the stock, then I'll go maybe around 25 or not 20 deltas, 16 deltas. So that's where you pick up your strike price, is which delta you want to pick up. How bullish, bearish, or what's your thesis behind it? So if someone asks me, is this a right strike? I don't know. How much are you bullish about? How much? What's your opinion about the stock? That's going to determine what delta you're going to pick up. If I have one indicator which has worked 100% of the time in last 2 months, and if that indicator is showing me that's the bullish one, I should go bullish. I might as well go and do in the money short put, right? Which I've never done it. Which means, hell, I know it will be above 175 after August 18. Or maybe if you have that 100% chance, maybe you should go and buy these out of the money calls, right? Because you need to have that confidence. You're sure that you know the lottery ticket numbers in advance. You have someone in the lottery department and those dices are rigged and you know what the outcome's going to be. In that case, I won't mind you going and buying deep or out of a money calls. But unless you have that, for me personally, you want to give a room for error, maybe pick up, I'll sell short put at 30 delta, 40 delta. If I don't have any position in a stock and I do want to buy the stock and then I have a cash available, maybe then I'll do 50 deltas, short put. Okay, and I don't mind the stock going down and coming, holding it at 143 cost basis. So that really depends on your outlook about the stock. Next, this is again more at a portfolio level. You don't have to worry about if you're doing only very small trades, very small option trades in a portfolio, and the rest of the portfolio is long stock. But if you are doing a lot more option trades, then you need to understand by doing this trade, how much of my overall buying power is being reduced. What will be my remaining buying power? The reason is this, especially if you are selling options, the buying power means what's the dollar value available in your portfolio to do more trades, right? Say if the buying power in my portfolio is 10,000. It means maybe I can do 10 more trades with each spread with $1,000 value, because that's the only amount of a risk which I can take, because that's the buying power available in my portfolio. Now, the reason why we need to keep an eye on this one as you graduate and do more and more option trade is this is not constant. Especially if you have any naked trades, means not a spread, this value will change. The value will change based on how the stocks have moved. If a stock has moved against you, then the broker would want to hold more buying power, would want to hold more of your portfolio value in case to cover themselves up. If the volatility has suddenly gone high in the market, it means that suddenly the stocks could move more than expected when you put the trade. Then it means the trade has become a little more riskier. Then the brokerage would want to cover them. They would want to reduce the available buying power to you. So make sure that you are not using more than 50% of the available buying power, especially if you're doing an unlimited risk trades. If you're only doing spreads, then it's fine. And you'll still be okay with not using, the rest 50% of the buying power. The way this helps is when days like March 2020, I don't know which day was it, when the market fell down, like we saw 35% drawdown in the market. If you have not used, say if you have already used 70% of your buying power, when the market fell down 30%, your brokerage will immediately give a margin call because your positions are too risky. You don't have enough of a buying power available
to hold the trades that you held. And that's where we start to see these horror stories come in, wherein the brokers will clean up your portfolio to protect themselves. So my sweet spot is around between 30 to 50% of using only 30 to 50% of buying power. So gone through it 2018, December, down, those December when the market broke down, gone through 2020s of market drawdowns, gone through 2022 market drawdowns. I don't have to worry about getting margin calls. You can sleep well. Because we don't know tomorrow what could happen in market. So many brokers, the good brokers will show you what's your available buying power. TD Ameritrade shows you, Tastyworks show you. I don't know if Robinhood shows you. That's why I don't like Robinhood for foreign options. It just doesn't have any good info to make right decisions. So one way to avoid those scary margin calls is make sure you have enough buying power so that if market is down 10%, 15% tomorrow, your positions are not being sold. Brokerage firm is not making a decision on your behalf. But again, this is a little more advanced concept when you started looking at an overall portfolio. It might seem stupid. You're saying, why I'm not using the full power available to me? Why I'm not using all the funds available to me? I'm leaving 50% funds on the table, but that 50% that you left on the table will help you survive in the long term. And you won't get wiped out if suddenly we see 2020 happen or 2022 happen. This is generally applicable for margin accounts. Yeah, I want to make it clear. If you are only cash account, then anyway, you don't have, the brokerage will always block that cash that you have to use for a trade. Okay, any questions? I know this is a little more generally not talked about, but it is important if you want to build a longevity in option trader. Everyone is a great option trader for a year when the markets are doing good. But the fun is when the markets goes against you. How do you stay alive? How do you stay active? How do you not get any margin calls? How do you still continue to be in the markets? And how do you not let brokers take a decision on your behalf and sell the securities? Is keep an eye on your overall buying power. I see a question. Buying deep in the money is better than buying put deep in the money is better than shorting the stock. Kind of yes. If you just want to go and short the stock, then you have to also pay for the dividend on the stock. Then you have to also pay for the charge for holding that short position. But you can again buying deep in the put. Deep in the money, it's fine. You're paying less for your extrinsic premium. Okay? But for me, buying options is generally doesn't work out. But if you have to short the stock and you don't know, short the stock without doing a good risk management, or rather better is to buy deep on the money put. Bobby, is Robinhood a good brokerage in general for buying stocks when compared to Interactive Brokers or TD Ameritrade? Its a UI is very intuitive. I'm not saying good or bad. Depends on what you're looking for. If you're looking for an easy interface to buy and sell the stock, it's very easy to use. Do you get the best price? Probably not. But do you really care if you had to pay 20 cents extra for this particular stock or not? Maybe not. Then it's fine. If you're doing options, then I would suggest stay away from Robinhood. because I don't know now, because now I've not logged into Robinhood for months, ever since I cleaned up my account. But there was not much of information available to make the right decision. I can't even see, what's the extrinsic premium left on against, what's the extrinsic value against a strike. Then how do I make a decision if I'm on a risk of getting, early assignment or not? So, but just for buying and selling of a stock, the UI is good, very intuitive, and sometimes it may make you trade more often than you want to, but I wouldn't, I'll be okay with that. On portfolio margin, use even less BP percent than regular T. It's more leverage. Exactly. Yeah, but I think for portfolio margin, you have to pass some test and then do it. So I'm not assuming that. I think most of the folks who are new probably are on regular T margin and not on portfolio margin. Can you review the roll strategy, pro and con of roll out higher compared to keeping the same strike price? Maybe in next session, sometime when we talk about managing the trade. So we can talk about pro of roll out and moving to higher strike. You pay dividend when you sell a call or buy a put? No, you don't. Only if you're a short stock, then you have to pay a dividend if the company has announced a dividend. But if you bought a put or if you have sold a call, then you do not pay dividend. VBull is another one which you can use, much improved lately. Yeah, I think I heard some good things about VBull. I haven't used personally though. I mean, I have 2 is more than enough. I don't want to spread more. Now, if the Charles Shaws try to play tricks with Thinkorswim and I'm out for another brokerage firm, I think this interactive brokers is on my list. But right now, I think I'm happy with 2 of them, Thinkorswim and Tastyworks. Cool. So that's the last one, overall buying power. So takeaways: order, position size, make sure it fits your portfolio in terms of your asset diversification, good liquid ticker, implied volatility will tell you, should I wait? Am I getting paid enough? Do I have enough buffer? Am I getting enough buffer to do this trade or not? Then you look at your strategy, whether you want to go bullish, bearish, slightly bearish, neutral. And the best thing about options is you can be neutral about stock and still make money. Right? You can't do it with a stock. If you buy a stock, then stock has to do something. If you're bullish, stock has to move up. If you're bearish and you short the stock, then the stock has to go down for you to make money. But the cool thing about options is even if stock does nothing, you could still make money. Even if stock move up or down a little bit, you could still make money. There are so many ways to craft your trade using options. Then you look at what's your expiration date. Are you doing earnings trade? Or are you trying to do a stock substitution, stock that you want to hold in your portfolio for long, but you don't want to use the capital, want to be a little more capital efficient? Now, in today's scenario, be careful on the leap side because now the Vega has come into picture. And that's another row, which means your interest rates. So far, I never had to worry about Vega because the interest rates were close to zero or they were never moving much. But now the interest rate is what, 5%? And in near future, it's going to go down. I haven't spent enough time to study the impact of Vega on your long dated options, right? So I don't know now with coming of the impact of the interest rates, how is it gonna make your, let's say, your deep in the money call that you bought more or less attractive, right? Because that was never a situation, never spent time in understanding it. But In a short durations one, it doesn't matter much, because even if the Fed changes in a monthly basis, they only changes 25 basis points, 50 basis points. Over a year, today it is 5%. In 18 months, the interest rate could be 2%. Okay? So right now I'm not doing too much of a leap because I don't know how that the Vega impact will impact the position. So just be careful. And if someone is doing a leap options, you ask them about a Vega impact, then you'll know, are they really options, or are they just like scratching the surface of options? Right. Then look at a strike price, which delta you want to pick up, and then final make a decision. Should I do 10 contracts of it? If I do 10 contracts, gosh, it's going to eat up the buying power that I have available. Maybe I only do one contract. Right? Overall buying power consumption. This is to extend our longevity, to go through the gyrations of the markets, to go through the downturns when the market suddenly, you get up in the morning and market is down 10%. Right? So how do you still be active and alive is, hey, have enough buying power available to you. So that's all on it. I know this is too many things, but if you do it enough, it just becomes a muscle memory. Right? You know what you already hold in your portfolio. So portfolio fit is fine. Position size, with experience, you'll know that I have only one contract. Maybe I'll do only 2 of them. I don't want to have put more risk on the trade. And implied volatility, you look at your chart and you know where the IV is. Becomes pretty easy. Don't have to spend time. But initially, you'll have to think through this to make sure when you're doing a trade, you're actually doing it a right setup. Hope that was useful. And there we hit our 2-hour mark. So forget about everything else that I told. Big tech bets in there is an article I'm not going to go through now. It's a long one. We'll save it for some other session. But I did spend yesterday night a lot of time in reading through, and maybe you got a time you can go and read yourself, is Big Tech, Big Bets by Matthew Wall. Very interesting if you really want to understand and know about how, Apples and the Googles and how big tech and why and how they are creating a moat around themselves. It's a very long article though. So have a lot of patience to read through this. So I spent a lot of time yesterday in going through this. Not going to go it now. It's already hit our mark right now. What else we want to talk about? Yeah, this one I do want to talk about it. Sometimes the CEOs, they play the games around the shorting of a stock. Sometimes why the shorting the stock could become so dangerous is if you short the stock, they have to borrow the stock from a lender. Right? Anyone who's shorting us, if you are shorting a stock, your brokerage has to borrow the stock from somewhere and the return it where they are done. Right? So short sellers, they borrow the stock, they sell it, they wait, then they buy it back to return to the lender. And that's how they make money. If the stock pays dividend, then the short sellers have to pay the dividend. It answers the questions earlier. Right? If a stock somehow become not tradable, then the sellers can't buy the stock back to deliver to their lenders, and then they're stuck. Okay. If the stock pays a dividend that is not a cash or regular stock, but some weird thing that is not tradable, then the short sellers can't get a dividend to deliver to their lenders, and then they're stuck. So sometimes some CEOs try to play the games with the short sellers because CEOs don't like short sellers. So this was an interesting, article I read. So I thought I'll share with you. Now we also talked about short selling. If you are a certain sort of public company CEO, you might spend time thinking about a question: how can I make my stock not tradable? Because if you make your stock not tradable, the short sellers can't get this. It can't deliver the stock how can I pay my shareholders a dividend that is not tradable? Because then the short sellers can't pay the dividend to the person that borrowed from, and hence they run the risk of not meeting the law, right? So there are two exceptions. I mean, if you're a public CEO, public company CEO, and you're focused on this, you shouldn't be the CEO. You should be kicked out, because your focus should not be on how to punish short sellers. Your focus should be on how do I grow my business. But there are two exceptions. If you're a bank, then all the business depend on confidence. We have seen in March that when little bit of shake in the confidence, SVB went down. All other regional banks started to go down. It was just a confidence game. If a bank CEO declining stock price can undermine confidence, then you may want to play these games to make stock non-tradable, or to issue dividend which is non-tradable or non-acquirable. Or if your business is pump and dump, right, then your whole business is about a stock price, right? There is no actual business. So in 2019, Overstock.com did a short squeeze. Its CEO had a long-running crusade against short sellers. And in 2019, he decided to destroy the shorts by issuing a special stock dividend on Overstock blockchain platform. Basically, each shareholder will get a shares of a new class of preferred stock. So it's not a cash dividend, a stock dividend. It's a preferred stock dividend, but that is tradable only on the Overstock blockchain, right? And it is not even tradable for all 6 months. So if you were short Overstock stock, you have to deliver the preferred stock to the stock lenders, but you couldn't deliver it because you couldn't buy it. You couldn't buy it because it is not tradable. But I think, so that was it. So he wanted to checkmate the short sellers, but looks like the lenders of the short seller, they agreed to take a cash instead of a preferred stock. So they were fine, right? And then they say SEC also investigated. Short seller also sued Overstock for market manipulation, but they never brought a case because Overstock also had another company which was in the blockchain. And I think that's how the CEO was able to convince, oh, this was not market manipulation. We're trying to grow our business on the blockchain, etc. But the short sellers, there was a squeeze that happened because then there was suddenly, how will the short sellers, I mean, they wanted to close their position immediately. So we saw a little short squeeze over there, but eventually I think the lenders agreed to take a cash dividend instead of a preferred stock dividend. So the short sellers are fine, but those who got the dividend, I don't know about that. So Elon comes to mind, who doesn't like short sellers. Piyush and I'm stuck with the dividend from Overstock. So now you have a preferred stock, but trades only on Overstock blockchain. That blockchain, I don't even know what's the status of the blockchain is. Is that even tradable? Can you even sell your shares or not? Oh my God. Sorry, Pishank, probably the cash dividend would work out better. Can you post the link of this article? I forgot where it is. Maybe somewhere on Bloomberg. I'll have to find that out. Hold on. I think it's Matt Levine. It was a longer article. There's a lot more stuff in this. I only picked up just one. There are a few other examples that he had shared in terms of some of the games that corporates may play to punish the short seller. So sometimes we see some special dividends coming out. There is more to it than meets the eye. I mean, that was the kind of a theme of that article was sometimes the games that corporate CEOs could play. All right, I think, yeah, hold on. I'll have to find that out. I don't remember what the link right now is. So let me go and search on Bloomberg. Let me just pick up a particular. text. All right. Any other thing you want to talk about? Otherwise, we're done for the day. I will search for that article. You found it. Okay, I'll post the link. Yeah, don't squeeze the shorts. Yeah, this was much longer article. Yeah. So hold on. But it was an interesting stuff that in these special dividends, there is little more, could be little more reasoning. I hope the companies that I own, they don't do this crazy thing. The CEO don't think about, hey, how can I kill a short sellers? But not all CEOs are above board. All right. Any other thing? Any new stocks that came into your mind? Oh, I saw Kava now has options. How is Kava doing? By the way, what do you think? Kava was a successful IPO? Oh, too wide, very wide bid-ask spread. Any thoughts on was Kava a successful IPO? So listed at $19, $20, $22 and was up to $47. It was 120% up in a day. Right. I would say it was a failed IPO because when I'm looking at it, I'm looking from a perspective of company and not from the perspective of bankers. Well, the people that made money in this were the bankers. A company left the lot of amount on the table. So my perspective, bad IPO for the company. Let's wait and see. Yeah, we have seen this time and again of all those meme stocks or the news stocks that have gone up 100% after IPO, probably went up further after that, and now crashed 90% since then. Many of them have lost 99% of their value. So we'll have to see how the business shows and not follow the stock price. I was looking at the CHK stock to invest. Do you have any thoughts on investing in natural gas? No, natural gas is, I mean, this whole oil and gas is one industry where I don't have much info on the business and how they operate. So unfortunately, I have no opinion on the business side of the house. Even on option side right now, the IV rank is so low that even if I were to do just an option trade on it, not okay. I don't know. Maybe when the market opens, the pricing will be a little more tighter, but doesn't seem to be a great from an option perspective either. $80 stock with a $3 wide bid and ask spread is not good. Yeah. So Bobby, that's why for my oil and gas stuff, I only have ETFs. LNG may be better since they will supply to EU. This whole natural gas has been very volatile. I'm even afraid to touch natural gas or because it's been known to kill many investors. It's very volatile. On the other side, it also made a lot of money for investors. No. UVX or reverse plate. These, yeah. Oh. UVXY. I think I had a chart on UVXY. Hold on. Yeah, now we are just riffing. let me go back and search. Way back, I think I did one. We talked about volatility instruments in some of the session. Which is that? Where I think I fished out some data on if UVXY had not done reverse split, where it should have been trading. Hold on, let me find. I think it was UVXY only. It was some ridiculous, a few $1 billion if it had not done a reverse split. I mean, if it should have started its journey at a few $1 billion, something like that. I can't find. Let me see. There we talked about a lot of volatility products. Okay, I think, let me just bring that up. Volatility products, retail investors. Because I do see suddenly a lot of interest in these volatility products. Damn, where's the document? No, I guess can't find it now. Anyway, have you done PMCC poor man covered call? Yes, I just did on PayPal. So PayPal, after review of a PayPal that I did, I bought deep in the money call because the volatility was low. The volatility only kicked up this week. So volatility was low. So I was paying very less for extrinsic premium. I went ahead and bought deep in the money long call on PayPal. And then this week, I sold a call against that position, which is what exactly is a poor man covered call. Substitute your stock with a leap option and then sell a call against it. So yes. It was going for $2, now 20, just don't buy, always thanks. Yeah, UVXY is a reverse split. Jason, I was comparing these PMCC, surprised at a BP usage. Buy one diagonal. I was looking at 21 June 24. And then you have to decipher what this trade means. So you're basically buying, where is the Ruby trading cat? 484. So basically buying 21st June 2024 call, $300 call, if I'm deciphering a trade, paying 100 and sold 30th June, which is the next week, 475 call, and you're paying $192 for it. So it's a $400 stock. So I think that 192 is like 50%. So what is 300 call, which is, okay, very deep in the money. Yeah, so it is 190, close to 190. Oops, okay, let me unmute you. Go ahead, Freddie. You should be able to unmute yourself now.
Can you hear me?
Yeah.
Yeah, so I work in IT, and the last 2-3 months, Adobe, kind of install a new package into the Adobe Reader. So if you have Adobe DC Reader and you had Adobe XI, Adobe DC, an old version, so what they'll do is, oh, well, you have to remove this software if you want to use Adobe DC. So they force you to remove it so you can go to subscription mode. And this is the last 3-4 months. And that's why you can see that they're forcing companies to buy the subscription mode when they can use the old version. So that's why if you pull up Adobe earning, you can see it's going up, and you can see the chart. It's because of this, and this is gonna even happen more and more, because I had to go in the last 2 to 3 weeks, going to the users' desks and removing all the services. And most people will not know how to do this process, but a basic user will not be able to go in. There's a lot of things you have to go in and do some scripts to remove all that all that software that they installed on the Adobe products to check if you have an old existing one, and then they force you to upgrade, and they force you to remove the old version of full Adobe that you paid for and go to subscription mode. So I think this is the reason the last report was so big, and that's why the stock took off. It's because of that new checking software packages that they added into Adobe. And that's why, if you look at the report, it was pretty good. And that's why you see a big jump in Adobe. And I can see it going much higher because, like I said, it didn't happen all the same time. I'm getting people slowly. So far, from like maybe 100 PCs, I only seen it in about 10, 15 people. So they're slowly doing it, not like doing it all one time, but slowly forcing people to remove the full version of Adobe products, the Adobe Acrobat, so they can do it. So they're doing it like it's some kind of random code.
Got it.
To do that. So you can say, oh, you still have it, okay? They're not subscription, but look, they're gonna put in the new engines, and it's gonna force you to remove it. They won't let you upgrade or won't you let you do anything unless you remove the old product. And this is new. This is just started within a few months. Like I said, who's that? Must be Shang said that, but yeah, like I said, it's slowly happening. They're not doing it all one time. The code is probably doing it's random right now. So I'm just letting you know, you can ignore it, but they actually force you to remove it. They will not let you install Adobe DC on your system unless you remove the old full version of it, unless you fully purchase subscription mode for Adobe DC Professionals. Okay, and I think that's why you see that big spike.
Yeah, no, thanks for sharing. This is really important information. So I think now Adobe, as we all know, they've been moving towards subscription for a few years. Now they are trying to force either you get stuck with whatever the old version you had. In a new version, there is no more paid once used for life. New version, only version available is subscription, and looks like that's what now they're forcing everyone to move to subscription if you want to do any upgrade on that one. And very soon, the version that you may have will become out of support. And they say, guys, this is out of support. If you want, as a company, if you want to support on it, you have to come to a newer version, which is available only in subscription mode. And that's and the street values the subscription-based business way higher than the license-based business. So I'm not surprised Adobe using this tactic to push customers to move towards subscription-based. But I guess if you still have the old one, you may not get support on it. You will not get new features on it, but I think you can still use it. Otherwise, that will be a kind of illegal to stop using that one. But yeah, looks like now they are forcing more and more people. It's a forced upgrade on forcefully moving them from license to subscription services, which will be great. Jay, you had your hand up.
Yeah. So do you know how to paste the trade I put in? Do you know how to paste that into TOS? You don't have to manually.
You want me to do that? Yeah.
Yeah, because I wanted to compare the call and the put side, and I was surprised at how much less capital it takes to do the put side. So I just wanted to point that out. Yeah, you can paste it there into the order
Yeah,
and then
that's
analyze it.
Where's my, there we go.
Okay, so that's the call side. Analyze that, and then also do the same.
So this is your deep in the money call, and that you're selling your short dated call against it. Your PM basically poor man covered call.
Yep. So if you throw that into analyze, right click, analyze it. So now take my second trade, which is the same but with the put.
Let me just pin it.
Yep, you can analyze that. You'll see that they're the same. Yet the put one takes less than half of the buying power. So I was surprised at that. The P&L graph is the same because it doesn't matter put or call on a spread. Now the call one takes, for me, like almost $20,000, but the put one takes $9,000 to do the same trade.
For me, the put one says $5,000.
Okay.
And the call says $14,000.
Yeah. So still, it's 1/3. For me, it's half. I have Recti on this account. You have PM. But isn't that interesting? Because it's the same trade.
No, but because you got one naked call on that run, right? So
no, there's no naked call. It's a covered.
Yeah.
I'm buying the leap.
You have a 300 call leap over there.
And selling the short-term call on top of it. And the second one is just the same thing, but I flipped it to puts, both.
Yeah.
So you see the graph is the same.
Yeah, graph is, it's instead of a call, basically just flip from call to put. I don't know if is that done something to do with the call skew? Because
I don't think it's the skew. I think it's the margin calculation is just completely different. So like if I was to do this kind of stuff, I would look at the put side because you could just take so much less money to accomplish the exact same thing.
Yep. No, this, yeah. It does that. Is that the same P&L?
Yes, same exact P&L, same theta. If you open up the slices, you can see on the price slices, it's the same Greeks, just less money. Oh, unlock the price there. Yeah, there you go.
So got
well, let's see. You have 532 is not the price. I don't know why. Oh, you have it plus 10%. You got a reset. There you go. So 54 theta on that one.
So it's a 25 delta position.
Yep.
Yeah, almost similar,
so
right?
It's because of the bid-ask spread. It's not exact, right? Because the end of money ones have big spreads, but it's the same trade, same strikes as the same trade, right?
Yeah, interesting. I need to ask this question.
Yeah, people usually don't look at the put side. When they do PMCC, they say, "Oh, do this call, the end of money call." But I just thought, well, let me flip to the put side, and just found this out.
Yeah, no, yeah, this is interesting. Yeah, only did it because I did a leap on PayPal after that. I'm like, yeah, looks like PayPal is undervalued, so did a leap. And this week, because the IV was higher, I'm like, okay, let me reduce my cost basis of that leap. But yeah, this is interesting to figure out why. I don't know, is it with every brokerage or is it how the TD Ameritrade does it? I'll maybe try to throw the same trade on Tasty
stock
and see what that shows up. Okay. All right, probably I'll do that later. It looks like someone is on the door.
We'll talk about it next week. So.
Yep. Cool. No, interesting, man. Thanks, Jay. All right. Guess that's it for today. Thanks, everyone.
Thank
Sorry,
you.
little bit of a Zoom bombing. Looks like we all are famous now. We have more than one Zoom bombers. We have matured. We have arrived, looks like. Thanks not. Talk to you. Oh, yeah. No, next week is a long weekend. Hold on. Let me just look at the calendar. No session on next week. So you get your long weekend. Back to you. I'll cancel the session and meet up. So we're gonna meet a week after next. Thanks, everyone. Have a nice Independence Day break. Hopefully, if you have a holiday Monday, my office has Monday as a holiday, so we do want to take some time off and enjoy as a family. So no session next week. Talk to you a week after next. Bye-bye.